Welcome, everybody, to the New York Alternative Investment Roundtable August event, Taper Tantrums and Fiscal Cliffs, Weaning Markets Off Pandemic Largesse. I am Alessandra Choco, the president of the Roundtable, and we're glad you can join us this afternoon. Before we get started, I'd like to take a moment to thank the Roundtable sponsors. We are eternally grateful to have such a professional group of actively involved sponsors within the industry who guide us on the types of events that folks like to see. So we really appreciate having them. And now for a few logistical issues. We are running today's event as a webinar, and this means you won't be able to see the other participants. However, we will be seeking questions of the audience, and we would ask you to use the Q&A button or the chat button because myself, New York Air folks in the background, and Daniel will be able to see those questions and we'll get to answer them. So on to the event. Today, we're lucky to have with us Daniel Sternhoff, who is the Senior Managing Director for Medley Global Advisors and the head of macro content at Energy Aspects, where he leads his firm's Washington research, focusing on monetary, fiscal, trade, regulatory, and foreign affairs. Daniel has more than 20 years experience helping top investors and corporates and sovereign entities navigate their exposures at the intersection of global politics and financial markets. Before joining Energy Aspects, he was a managing director and head of U.S. research with Macro Advisory Partners, where he led that firm's emerging markets practices with a particular focus on oil markets, China, and energy geopolitics. And prior to moving into consulting, he was a Jerusalem-based correspondent with Reuters and directed the news agency's Treasury and Foreign Exchange desk in New York. And now, without further ado, I'm going to turn things over to Daniel.
Wonderful. Thank you.
Thank you.
Can you hear me? Perfect.
Yeah.
Zoom check. Thank you, Ali, and thank you to everyone who is joining today in August. This has been a much busier than expected August in the markets, some markets, specifically fixed income and treasuries. And there's a lot that is in play. And so I'd like to take much of this time, if I can get my screen to work, to talk about what is happening with the Fed, with monetary policy, with the big fiscal packages that are moving through Congress, infrastructure, and the beginnings of a big Democrat-only bill, all in the context of where we are in the economy and trying to keep it focused on what this means for markets. By way of a quick introduction, my firm, Medley Global Advisors, for those who don't know, Medley is a policy research and advisory firm. We have been around since the late 90s. We focus on any areas of policy that are impactful to financial markets. This is across major developed and emerging markets, monetary, fiscal, regulatory, politics, political economy, and geopolitics, helping a clientele, mostly buy-side asset managers, pension funds, hedge funds, and prop operations, and then some sovereign entities. So without any further ado, what I would like to do is start framing my remarks a little bit on what has been, I think, some really unusual developments in the markets over the last few months that had caught many people offsides. I think many on this call will be aware. We started the year with reflation trades coming on strong on the heels of the Democratic takeover of the Senate, rollout of vaccines, expectations for global reflation, and expectations are pretty widespread that this would be driving US bond yields higher. I think a very consensus call was for bond yields to get up to 2%, and we were seeing reflation plays across equities, cyclicals, commodities rallying. and so forth. And of course, we have been seeing some really astonishing growth numbers out of the US, but also catching up in Europe, more problematic situation in Asia and elsewhere. China has been decelerating, but still relatively strong. But on the whole, a story of strong growth and rising inflation. And what have we been seeing in the bond markets has been a real collapse in yields. Not only did we see a pullback in treasury yields below, down to the 1-2 zone, but real 10-year yields, as this chart that's up here shows, fallen all the way down, steeply negative territory to the lowest levels of the pandemic. And there's a lot of discussion about what is it that the bond market is signaling with this relentless flattening of the curve and fall in yields. And I think there have been many explanations, all of which sort of feel like they're trying to fit a narrative to the price action rather than a great or perfect explanation. And so of the reasons that have been cited, it has been, is it peak growth? Was Q2 the sheer top of the cycle? And now we start to see a second derivative deceleration in data. And behind it, is this growth sustainable? Has it just been fueled by huge monetary bazookas and the giant fiscal programs from last year's CARES Act to the December package to Biden's American Rescue Plan? Are we now about to burn off all of this stimulus and go back to secular stagnation? Some who follow a lot of sell side notes a few weeks ago, Goldman Sachs made some headlines with a second half of 22 call that US growth is basically going back to a pre-COVID, post-global financial crisis, lackluster, lowflation trend. So there's this peak growth, secular stagnation argument. There's obviously been the rise of the Delta variant. There has been questions about, will we see fiscal drag in the US as big programs burn off? Congress might do a small bipartisan infrastructure piece, but we're not going to see any packages as large as what we have seen. So therefore, what have been fiscal tailwinds turn to headwinds. We have had some concerns. Is the Fed turning hawkish? This was propelled after the Fed's June meeting, when their dot plot signified that from a median of 0 members of the committee expecting rates to rise in 2023, there was a median expecting 2 hikes, and this triggered a flattening of the Treasury curve. Some is just positioning. The entire market thought yields were going up to 2%, and when things started to turn, everyone's running to the other side of the boat. The other explanation is Treasury supply. Has it simply been the Treasury drawing down its general account and the impacts that has had on issuance? These are all factors in the mix. Some are explanatory, some aren't great. But in my experience in speaking with clients, there's been a lot of focus on these peak growth arguments, or even if we're decelerating, that's a part of it. And I wanted to address that first to give some context about where we are in the cycle, and the contention I'd like to lay out is, sure, Q2 was the peak, but the US economy is decelerating to something that is still extremely strong, well above trend, and has legs to continue to do so well into next year. And so the biggest challenges in the economy are really capacity constraints and overheating rather than peak growth. And just to kind of go through a few charts laying this out, which will segue into a discussion about how is the Fed seeing this and what are they doing. Just a handful of slides here highlighting why we think we've got a really durable expansion. It's not just the peak of it, it's the extent. Manufacturing. Obviously, manufacturing has been super strong. There's been commentary around some of the last ISM reports that the prints are coming off the peak. This chart looking at the headline PMI, we've basically been close to 60 for the better part of a year. This is unheard of. What's notable here is that inventories continue to fall, even as production is super strong and new order books are still incredibly strong. This points to a manufacturing sector that expansion that can go not for months but for quarters, looking at new orders and inventories. Obviously, prices have been a big story. They have been coming up. It's notable that even though we have supply chain bottlenecks and rising prices, which are maybe weighing the headline a little bit, it's not enough to really derail the manufacturing story. Then, of course, consumers, the consumer fuels everything in the US. Consumer balance sheets are extraordinarily strong. And it's, I think parts of the story of consumption, not only did we have unprecedented levels of fiscal transfers during the pandemic through checks, through the new child tax credit, through all of the various benefit programs that have simply moved cash into household balance sheets, which has led to a huge jump in savings and rises in disposable incomes. When we kind of measure excess savings, so this is how much actual savings has increased relative to where we were before the pandemic as a percent of GDP, we now are looking at something close to 6% of nominal GDP in excess savings just sitting there in bank accounts. And this is dry tinder to be spent. What's fueling this is not only transfers, it's also, the chart on the right shows, these are real disposable incomes when you strip out transfers. We basically have more than filled the decline from the pandemic gap. And what is astonishing about that is there are still roughly 7 million people unemployed now who were employed before the pandemic. But this is aggregate disposable income across the US, not on a per capita basis. So even though we still have a significant unemployment overhang, incomes in aggregate are back, and there's a huge savings overhang, and of course wealth effects for those who have assets. Those effects are really large as well. What can we see? Spending is back. Chart on the left shows retail sales at restaurants and bars. This was slower to recover than goods. It was expected that as we moved through a vaccine rollout and into the summer, all of this stuff would recover, and it has. Services are now back to their pre-COVID trend. Many had thought that a lot of the story in the US during the pandemic was everybody was locked in their houses. You couldn't spend on experiences, so we were just buying stuff on Amazon, and spending on goods went through the roof, and that's why we had shortages of, bicycles and bathroom fittings and the like. What we're seeing in the data is services have recovered, but goods purchases are not falling. So we don't have a rotation or a handoff within consumption. We just have it continuing to be super strong. And when we look at inventories, inventory to sales ratios, goods, they're really low. So those, again, you have strong consumer, strong balance sheets, and of course that's part of what's fueling the manufacturing story. Then, really important story here is what is going on with corporate CapEx, and maybe taking a step back beyond just where are we in the pandemic. It's notable here, this chart on the left is showing average annualized growth rate in the net stock of private investment, non-residential investment. And as you can see, it had been 3 or north of 3 basically from the 1950s to the 1990s, and then it's been very weak for in the 21st century. And there's a number of reasons for that. It was the popping of the tech bubble, it's China's WTO entry, it's the sluggish investment universe of the global financial crisis. It's been quite weak. This may be turning. So if you look at on the right, these are expectations of capital expenditures captured in all the various regional Fed PMIs, and they're very high. And of course, given that we have tight labor markets that are really across not only low-skilled and professions, but broadening out, this creates the conditions for accelerations in investment in digital infrastructure, and there's a lot also happening in the trade policy realm that could see higher levels of corporate capex. And again, this is an important piece when you're thinking about the secular stagnation arguments. If we are seeing, capex contributing something higher than it has the last 20 years, that's important, and there certainly are at least signs that that's possible. And then housing. A lot, obviously, housing prices are going crazy. A lot of the storyline is people fleeing cities during the pandemic, going out to the suburbs, Zoom boom towns and the like, shooting up prices of single family homes and leading to a crazy market. Just want to make the point that this is not only pandemic flight. This is demographic, and we're in the middle of a significant generational demographic boom. Chart on the left is showing new household formation. And if we haven't had the supply catching up to new households, coupled with the pandemic factors, this is really what turned housing markets from red hot to white hot. And obviously, there's people who look at housing numbers have focused on, well, are people discouraged because prices are so high, or you're discouraged because you can't buy anything because you show up at an open house and it's gone in 24 hours in a bidding war. And so, do you see a rollover of single family sales, or do housing markets soften? The point is that the backlog from a construction activity standpoint is really strong when you look at single family permits that have been issued but have not yet started. So basically, adding up that, we have manufacturing, capex, housing, and the consumer all looking really strong. And then, of course, big part of the consumer is jobs and wages. Now, jobs markets obviously are recovering a lot. As I'll discuss in a bit, the labor market matters a lot to the Fed on the employment side of its mandate, as it weighs when to start to pull back on asset purchases and extra accommodation. Really strange labor market right now. We have more jobs available than unemployed workers. That's the message from the JOLTS survey. We got the latest numbers this week. Lots of obvious reports of labor shortages, which can even lead to cutbacks to services, and it's putting upward pressure on wages. And things that the Fed likes to look at, like this Kansas City Fed Employment Conditions Index, is pointing in the direction of lots of strength. And it's obvious we are going to have a strong job market. The expectation is that constraints to labor supply, such as the inability to work because you have to stay home to take care of kids, or you were worried about pandemic health concerns, or you were collecting really generous unemployment benefits, all of these start to roll off, and then we close that gap. This glass is still half full. There are still 6 to 7 million people who are unemployed relative to pre-COVID levels. And while the labor participation rate is recovering, it is still a lot lower than it was before the pandemic. So we still, don't yet have people coming back into the labor force, even though there's plentiful jobs. So either wages need to keep rising to incent that to happen, or there may be some other structural things happening. But nonetheless, wages are rising, jobs are rising. Both should be continuing, all of which points towards further strength as we're continuing through the cycle. There are clear expectations that we will have we may end up with a 7% GDP, real GDP number this year, decelerating next year. Range of expectations are in the 3.5 to 4, which is still above trend. The question is will we come in at the higher end of that? Those are still quite strong. Based on the previous factors, you could make the arguments for the higher end of that range. Obviously, big question pertinent today. We got a big CPI number in the US. Is this inflationary, and will inflation, bad kind of inflation, stop the expansion or dent consumers? This is a big part of Fed thinking. I'll get into a little bit more detail. These charts you see here are not updated with the numbers that just came out a couple hours ago. Part of the point is the Fed, I mean the core leadership of the Board of Governors and leading districts, mainly in New York and San Francisco, who have been kind of on the more dovish side of the spectrum. The narrative has been the inflation that we are seeing is transitory, related to the mismatch between supply and demand as everybody comes out of their pandemic holes and reopens, but supply chains can't catch up fast enough. So why used cars and airfares have been driving lots of the inflation story. I think the numbers we got this morning do point in that direction. There was a deceleration in core CPI to 0.3, which, when we've been coming off much higher numbers the last few months, that feels like a big deceleration. That would still be a, 3.6% annualized rate if extended, which is way above the Fed's 2% target. Nonetheless, you can see that some of these reopening categories are starting to ease a little bit. Used cars calming down, airfares to a degree, but absolutely it is not possible to declare an all clear on inflation by any stretch of the imagination, because I think the kind of buried in the numbers this morning, you can see things like personal care and recreation and even like delivery services. It's all starting to creep up stronger than it had been. And so those are, there are elements in where prices are going that do raise real questions. And one of the biggest shifts that we are seeing, ironically, while financial markets have been, forward inflation break-evens have been declining relative to where they were a quarter ago and coming off, the concern level about inflation inside of the Fed has been rising, and I'll discuss this a bit. Part of what will be problematic inflation? Well, it will be, do we start to see rents, what the housing prices bleeding into rents, bleeding into core inflation? Doesn't show up yet in the numbers, but it's likely that it will. Wages, do they pick up a lot to the points that we're getting lots of pass through? And do the things that are supposed to be transitory reopening categories, do they not fall as expected? These are the question marks to be determined by the data, and that really goes to the core of what does this all mean for the Fed. Maybe just one last slide here before discussing the Fed. Of course, as I've been talking about all of strength, capacity constraints, overheating, inflation, which is at odds with this narrative of a flatter Treasury curve and lower bond yields. A big part of the bond market story, and I know a view within the Fed, is this is about the Delta variant, principally the impact of the Delta variant overseas and what it is doing to drive demand for treasuries and slower growth elsewhere, rather than what it's doing inside of the U.S. But it obviously remains a risk inside of the U.S. This chart on the left is showing, Australia, which adopts lockdowns as a policy. You have quick and immediate impacts from this latest wave. We're not really seeing that in the US and Eurozone, even though cases are moving along rapidly. The chart on the right, this comes into why we think this episode will not have as big an impact on activity, is clearly, especially in areas with high vaccine penetration, vaccines are offering protection against severe disease, hospitalization, and death, which is what they are supposed to do. You see in the US broadly in aggregate, hospitalizations not rising commensurate with cases. when you narrow down on highly vaccinated states versus those in the South and Southeast that have only 30-40% vaccine penetration, where they're having a real problem, it's a different story. But those places that are seeing the biggest COVID waves right now are also the least likely to embrace distancing, lockdowns, and mobility restrictions, which is as much about local politics and cultural preference. So obviously it's something to watch, but for the time being, it may take the top off of things like hotels in the fall, but don't think that this is going to threaten the fundamental story about the trajectory of the recovery. Now, what does this all mean for the Fed, and where are they? The Fed is absolutely in motion, and if anything, over the last weeks, based off of our soundings across the FOMC spectrum, there's definitely some movement here. The movement is really the more dovish parts of within the Fed are, one, becoming a lot more bullish about labor markets, what they're seeing in the recovery, much more confident this is going to continue, and obviously seeing the wage story and believing that we will be seeing a very strong jobs recovery moving forward in time as labor supply constraints ease. Have not yet gone far enough for the Fed to say we're ready to start tapering asset purchases as a committee, although there are members who say we should have started tapering yesterday. But we're clearly moving in that direction, and even the most dovish members are saying we should be doing that later this year. This is, people like Charlie Evans, and we've heard it from even Clarida Brainerd, making the case that the conditions will soon ripen for that to happen. I think a couple of points here. The inflation numbers are still looking problematic within the Fed. The hawks, what they are looking at is, the Fed in June, when they put out their summary of economic projections, they said that core PCE inflation for 2021 will be 3%, before decelerating down to 2.1 next year and the following year, which is the transitory narrative. So, surprised by how high it's been, but it's going to roll over. It's very clear that those numbers were stale the moment they printed them. Even mathematically, taking the CPI numbers we got today, even with a deceleration in core CPI to 0.3s or 0.2s for the rest of the year, that would put PCE inflation, closer to 4 for this year, which is a much higher level and will bleed forward into forecasts into next year. It's highly likely that as the Fed redoes its forecast going into their September meeting, that they will be again raising their 21 inflation number, and even though it will still come off into next year, that number will also rise. What that's doing is the hawks within the Fed system, and many of the hawks are mostly district presidents who have their ears close to the corporate constituents within each of their districts, who have been hearing about supply chain problems and labor shortages and pricing issues. It's very obvious to this cohort that there is no reason to continue to pump this much accommodation into this economy. And even though they also expect inflation will moderate next year, the risks are very obviously weighted to the upside, and that if that case is wrong, they can't be in a position of having to scramble rapidly to mop it up or to lose control. And so therefore, they're pushing for an earlier start to beginning to back off these 120 billion monthly asset purchases. That conversation has begun. Even the more dovish core of the Fed says, yes, we're talking, we should do this later this year. The doves are still looking at the employment side. and they're saying, we just adopted a framework last year that says, let the economy run hot. We're trying to compensate for past low inflation under this flexible average inflation targeting regime. And we want to mop up all this labor. We want participation up, and we want, wages rising is a good thing, and we want the jobs to come back. So they want a little bit more time before they say the magic words, which is substantial further progress, which will be the signal that they say, we've met the conditions that we're ready to signal, we'll start tapering. Our read is that the doves, like Lael Brainerd, are not willing at the upcoming September meeting. They'll get one more job report, the August job report, which should be strong. That's not enough for them to say, we're ready to signal this. They want to see the data for September, which they won't get till early October. Effectively, what that means, because the Fed doesn't meet again till early November, is the doves want to be able to look at the August, September, and October jobs reports, review them in early November, and then say, okay, we're there. What the political argument is within the Fed right now is really the balance within the committee, and it seems like those that are more hawkishly inclined would be willing to start a little bit later if the pace of the drawdown can be faster. And this is I think important, because the Fed has had a standing preference based off of the 2013 and 2014 cycle, when they also had been at zero and were tapering asset purchases before hiking rates. They want to do this very gradually. And at that time in 2013, 2014, they cut their purchases by 5 billion each, treasuries and MBS per meeting, very gradual. There had been a preference to say cut 10 billion per month over the course of a year. But what the more hawkish side are saying is, maybe inflation is going to roll over next year. But if it doesn't, you can't afford to continue to be expanding your balance sheet, even if it's at a slower rate, all the way through the end of next year. So we want to cut the pace faster, whether that's 15 billion monthly, 20 billion monthly, how you slice it between treasuries and MBS. That's the current debate. The most hawkish side of the spectrum, we've heard from Bullard, who has said we should start tapering in September and wrap it up by March. And then that gives you time to monitor inflation and maybe even start raising rates in the second half of next year or Q3. That's not going to happen. That's, I'd say the extreme edge of the committee, but this could very well land over a couple of months toward a consensus to taper, to finish the taper within a 6 to 8 month time period. So if they were to signal in November, we've met the conditions to start this taper, December, you authorize it, and either they start the taper in December or maybe it's January. The point is not what month do they start, it's how quickly do they finish? Because then once you finish, then you have your eyes on when could you start raising rates. What is really noteworthy is a speech we heard last week from Richard Clarida, the vice chair, who turned a lot more hawkish, I would say, relative to where he had been. What we heard from Clarida, and I think you'll hear echoes of this from Powell when he speaks in Jackson Hole this month, although probably not with the same degree of specificity, is Clarida basically said, inflation risks are to the upside, labor markets are going to be strong. We still need a few meetings to monitor what's going on in the labor market, but we're getting there. Even more notable was his comment that if you look at the forecast the Fed put out in June, those forecasts were for 3% inflation this year, growth of about 7%, unemployment falling to 4.5%. And then next year, inflation rolls over to 2.1%, growth decelerates to 3.3%, and the unemployment rate keeps dropping below 4% to 3.8%. If those happen, then their conditions that would justify lifting rates off zero under their mandate, which is flexible average inflation targeting to moderately exceed 2% for a vague, considerable period, plus measures of maximum employment, they'll meet this by the end of 2022. So Clarida is saying, based off of the Fed's June forecasts on the current trajectory, we'll be in a position where rates could rise by the end of 22. That probably puts his dot into starting in early 2023. But the point is that those June forecasts are stale, and we're going to get an updated look at those in about 5 or 6 weeks. And it is mathematically guaranteed that the inflation numbers for 2021 and likely 22 are both coming up. The growth numbers will be very interesting to look to. And of course, the bullishness on the labor market is notable. So it is very plausible that within the Fed system, when you look at kind of the dispersion of the dots among members and when they project, when they think rates could move, there's 7 members that now see at least one rate hike in 2022. Obviously, the median of the committee is at 0 throughout next year. But if 2 people pull a dot forward, even if you thought, yeah, maybe the first rate hike, instead of being March of 23, it should pull forward into the end of 22, you can then see the Fed, the messaging through the dot plot signaling rates could start moving as early as the end of next year. That is something I think markets would take note of, because when you look at what are the bond markets currently pricing, the Eurodollar forwards, they've struggled. They've all year been sort of pricing between 2 to 4 hikes in 2023. We've just touched the lower end of that. Now, we're back towards roughly 3, but there's really not a belief that you can do a lot more than that. If the economy performs this way, and based off of where the Fed is, it wouldn't be hard to see that pricing shifting a lot. I'm going to switch gears away from the Fed, and we can come back to it in some Q&A. But one big point about the Fed's forecasts, they are not factoring in additional fiscal action coming from Congress, because the congressional story is noisy and messy, and it's unclear how big of an additional spending package we will get, when we will get it, or what its macro effects are. But again, relative to this narrative that we've heard a lot of about fiscal tailwinds turning to headwinds, what is going through the Congress is notable. Obviously, we're not going to see anything again like the $1.9 trillion bazooka that we saw earlier this year, which funnels most of its impact into over a matter of quarters. We're not seeing anything like that, but we are still looking at some really substantial numbers. And I'd like to talk a bit about what's happening in the Congress and the outlook, because I don't believe that this has been fully factored in. It's hard to get a clean read on where market expectations are on the fiscal story, but I've seen when you do surveys of a lot of economic projections and forecasts, they often have a lot of fiscal drag baked into them as the pandemic era stimulus starts to pull back. Obviously, that's the case, but we are likely to be exiting this year and going into next year with the kind of net fiscal impulse larger than it was in the pre-pandemic era. Now, what's going on in Congress? Really big week here. And just to speak a little bit on the politics of it, not just the policy. Senate has passed a $1.2 trillion bipartisan infrastructure package. 69 Republicans supported it. That's, former President Trump tried for 4 years to do something on infrastructure, failed. We now have, at least the Senate has passed something with a very strong bipartisan majority. With the support of Mitch McConnell, the minority leader. If you thought McConnell just wanted to kill whatever the Democrats do, he didn't. And the fact that 19 Republicans have supported this bill even though they know the Democrats are going ahead with this giant $3.5 trillion budget resolution filled with things that Republicans do not like, for the expansion of social programs, for the tax hikes, for an economy that may not need stimulus on that level. They still back the bipartisan. The White House worked hard at it. Biden worked hard at it. And at the same time, you have centrist Democrats in the Senate, like Joe Manchin of West Virginia, like Kyrsten Sinema of Arizona, but a broader group behind them, not only those two who get all the headlines, but Democrats from purple or red states, Democratic senators, who don't like the size and scale of these programs. Nonetheless, the White House said, we'll deal with the details later, get on board with this $3.5 trillion budget resolution, which just passed at 4 a.m. last night. And so, keeping the progressive and moderate wings of the Democratic Party united despite huge policy differences, and getting Republicans to support something bipartisan, even though they don't like what the Democrats are doing, this is some real political dexterity. And I think it's important to keep that in mind, because there's a lot of political questions about how are the Democrats going to come together over their real political and policy differences over the size and scale and components of this program and not have it fall apart. I think the political capital that the Biden administration is expending makes it likely that we're going to end this year with some pretty substantial packages being passed. Now, just a little bit about what's in them. The infrastructure piece, it's about $550 billion in new spending, not of macro import, in terms of what it means on balance, mildly stimulative, and adds a bit of a tail to activity over a number of years, slow moving stuff. The $3.5 trillion budget resolution that passed the Senate is going to be much more problematic. There's a lot of talk about what will happen in the Senate and what number could the Senate moderate support. What unifies Joe Manchin and Bernie Sanders? Where can those two meet? I think a bigger problem that people don't talk about enough is in the House. Pelosi is not going to bring the bipartisan infrastructure bill to the floor now, because the progressives in the House fear that if you do bipartisan, then that might be all you get, and that the moderate Democrats from more vulnerable purple districts in the House won't back the big bill, and therefore this all falls apart. So she can't pass the bipartisan infrastructure piece. At the same time, we've had, her margin is 3, and there are the Republicans expect they're going to win the House next year, and they see anywhere between 8 to 14 specific seats in play that they are targeting. And there's a number of centrist Democrats very uncomfortable with the scale of this package, and they have leverage if they want to say, we're not going to vote on this budget resolution unless we first get the vote on the infrastructure piece. So they have to work through those politics. Pelosi is more siding with the left on this one right now. She is going to try to bring this budget resolution to the floor in late August. And that's the first test will there be a group of 5 or 7 or 12 centrist Democrats from the Problem Solvers Caucus who gum that up. So these are complicated politics. And then on the Senate side, this $3.5 trillion, which is a huge number, including all sorts of things, I would view that number as a political messaging number. There's a lot of things that are thrown in there that are pleasing to progressives, but are highly unlikely to survive what's called the bird bath, which is the Senate parliamentarians' review about whether the specific programs and expenditures comply with the very specific and arcane rules for passing something through a budget reconciliation process that avoids a filibuster and can pass with just 51 votes in the Senate. There's a lot of stuff in there like immigration and policing reform, and then a lot of new spending programs on educational and family benefits that are unlikely to survive. So, we'd start with that number is not where it's going to be. That $3.5 trillion number, we have heard outright from Kirsten Sinema. She will not support anything that large. I think people are asking well, does that mean 3.4 or does that mean 2.2? Well, where are you going to land here? To be determined in a negotiation that's going to start now over the coming couple of months. But one point that I would make that I think is overlooked and important about this budget resolution, this framework for a reconciliation package that passed this week, is when you read the details of it, what a budget resolution is it provides reconciliation instructions to all of these 12 different committees in the Senate. And every committee, every different committee gets a number for their allocation. If you add up all the different committees, they get 1.7 trillion in new spending. And then the Finance Committee is charged with, they're supposed to come up with 1.8 trillion in tax breaks. This would be things like a lengthy extension of the child tax credit or big renewable energy tax credit. So basically making policy through the tax code. The Finance Committee only has to reduce their committee's instruction. They have to reduce the deficit by $1 billion. In other words, what this document does is it allows the Democrats to put up to $1.7 trillion of this package onto the deficit. So even though you've had moderates like Joe Manchin saying this needs to be fully paid for, the legislative framework they just passed allows for $1.7 trillion in deficit spending. And if you would, a very rough back of the envelope calculation, over 10 years, that's 170 billion. That's, 0.7, 0.8% of GDP. We're not going to see that. That much won't go on the deficit. But the point, again, going back up to this, what are the bond markets saying, and do we revert to some kind of secular stagnation? If we are coming out of this year with bigger fiscal than pre-pandemic levels, CapEx higher than the whole last 20 years, strong consumers, and then potentially some big labor productivity gains, it raises a lot of questions about the pessimism that's baked into the bond markets here. And then this is my final slide, and then we can go and open up to some questions.
We have a couple questions in the chat, just so you know.
Wonderful, great. So I'm going to wrap this up, and then let's get to it because I have been talking towards this screen long enough. Just to whip through this slide, basically what this is roughly telling us is that the bond market, when we look at inflation swaps, this is a 5-year OIS swap, currently struggling to price more than a Fed hiking cycle of 5 or 6 hikes over the next few years, right? The 23 Eurodollar market sees maybe 2 to 4 hikes. So this is, expectation of very shallow hiking cycle. And the real neutral Fed funds rate is currently flat to negative. So this is a market that is either buying secular stagnation or not expecting, a real cycle. And if we think about what happened in 2015 to 2018, that was, we went up to 2.5%. We had a, 250 basis point hiking cycle. That's certainly plausible even if inflation is retreating a bit, but if it's staying a little bit higher, because then, it will come off next year, but it matters a lot whether that's going to come off to 2.3, 2.4, 2.5, as opposed to 2.1 or 2 over the coming couple of years. And what happens with labor markets, labor tightness, labor productivity. But if we have a stronger contribution from CapEx and more fiscal, it's certainly plausible that the markets are misreading where the Fed could go. And obviously there's so much when we look at what gets discounted into other assets and the like, that aren't necessarily discounting that kind of a cycle. Obviously, there's a million reasons why it's hard for the markets to price it, not least if we see big inflation numbers. The markets will probably say, oh, the Fed's going to be hawkish, and then the hawkish Fed is going to drive us into a recession. And so therefore, you really can't get those long-term rates higher. So for that real higher rates scenario to play out, it probably is a long process, sustained consistency in the data to challenge secular stagnation thesis. That would take a long time. But again, are we in a new paradigm? And we've heard, St. Louis Fed President Jim Bullard says it's plausible. Obviously this is highly uncertain, but you can't say that there's not potential drivers between a different government footprint, higher capex, tight labor markets, that we won't be there. And if that's the case, you need to be flexible to start to prepare for that. So let me just wrap it there, and let's move to some Q&A.
Do you see them, Daniel? There's one in the chat box, and there's one in the Q&A box.
Okay, let me do that. Okay. Input on the proposed infrastructure bill seems to decline traditional spend plus still on code-related areas, which could be a challenge. So I think I'm not sure if the question is about the human infrastructure or the bipartisan infrastructure. I think this is the bipartisan infrastructure framework. This I think ultimately this is going to pass. Its headline number is 1.2 trillion. That includes reauthorization of what is baseline infrastructure spending. So the stuff on traditional hard infrastructure, roads and the like, that are authorized in the existing highway spending bill, whose authorization expires in September. All of that is getting re-upped. And then it's adding another 550 billion on top of that, including, there's a piece that's for EVs, but a lot of there's broadband, there's water, there's rail, and the like. So I think the package, this has not been tested in the House, but I don't expect that this is going to change very much, because I think the attitude in the House is whatever's not in the bipartisan bill, they'll throw into the partisan reconciliation package. I think the biggest, look, this thing has 69 Republicans in the Senate, which is important. I think there certainly are Republicans in the House who could and will support it, but the Republicans are not going to be the reason it passes. They're going to wait to see if the Democrats have the numbers on their own and then bandwagon behind it. This stuff is popular. So as much as former President Trump is, putting out statements trashing this bill, it's pretty easy for members to vote for putting their names on bridges, and it's needed and it's necessary. And it polls really well, and you had Mitch McConnell backing it. So I'm not worried about that becoming law. If for some reason this bipartisan moment collapses and the Democrats have to roll it all back into, this stuff will just get folded into a Democrat only bill. So I think all of these provisions are going to happen.
Daniel, you have one other question in the chat right now.
Yep. So this is on SALT. SALT restitution and possible compromises. So there is the Senate Finance Committee, in the reconciliation instruction that they have received from the Budget Committee, includes reinstating SALT to some limits. This is a political necessity. So Bernie Sanders, who runs the budget committee, who does not support it because the politics of it are, why should we be giving a tax break to rich folk? Who benefits? It's higher income people who live in high tax blue states who need that deduction and who were all targeted by the Republicans in the 2017 tax bill. Given that the Democrats, their whole pitch is on tax fairness and it's on raising taxes on corporations, reinstating the top rate for people with incomes over 400K, not doing anything that touches people under 400K and the like, this is off message to say we're going to reinstate this break. But it is important enough, both in the House and to key members of the Senate, that it's in there. Now, the question is going to be, what does it cost? And when they're playing around with the costs, where's the compromise going to come in? Does it get income limited? Which I think is probably likely. The way I would think about it is, I don't recall off the top of my head what a full restitution of SALT would cost. It's a big number. The way I would think about it is this. The Finance Committee has to come up with a substantial tax package, and they need all Democrats on the Finance Committee and then all 50 Democrats in the Senate to agree to it. There's going to be a top line number of how much in taxes are they going to raise on this economy. And, the big pieces that are in play are, you raise the corporate tax rate. Democrats, the Biden proposals are go back up to 28. We have moderate Democrats, so Mark Warner, who sits on that committee, I think they would support up to 25, but not more. Okay, that reduces how much revenue you can raise. I think there's clear consensus among all Democrats for raising the underlying corporate tax rate, for reinstating the top individual rate to 39.6, getting rid of a whole bunch of tax breaks that things like the oil and gas or even real estate, lots of these things. Lots of consent, 15% global minimum, international reform through what's called GILTI and BEATS. These are big provisions. I think Democrats as a whole can agree to that. There may be something on capital gains and dividends, but only for the highest earners and with fairly modest increases. And I kind of add up where I think all the Democrats could agree without, say, if you're Joe Manchin, they don't want to say they want this to be paid for, but they don't want to crush the corporate burden. So he's saying 25 on the corporate rate. Will it be, who knows? So the SALT number is in that mix. Let's say that of the international reform, the individual rates, the corporate loopholes, and then some money they get from Medicare savings. That to me adds up to like 1.8 trillion, maybe a little less than 2. So they have a $3.5 trillion bill or framework, but I don't think that you'll get Democratic consensus to raise taxes that much. So the SALT number, probably there's some SALT, probably they limit it to certain income thresholds.
Thanks, Daniel. Thank you, everybody. We're at our time limit, so it's a little bit after 1. So I just wanted to thank you, Daniel, for your insightful comments and your thoughts on the markets amidst the lingering pandemic. And thank you to everyone who's attended today's event. We hope you've enjoyed the presentation.